Did we just see a greedy move take place in the stock market? In today's video, we're going to be discussing just that. We can start to see a lot of greed take place in the stock market, where a lot of people are starting to feel that FOMO creep in, the fear of missing out. So we're going to be discussing the move that took place in the triple Qs and the SPY. So if you haven't already, please go ahead and like the video. Make sure that you subscribe to the channel, that way you can get our future videos whenever they're released. So without further ado, let's get right into it. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax, and let's get right into it. Now, if you can do me a favor, please go ahead and leave a comment below of what kind of drink you are drinking. I am currently drinking a Colombian coffee from Trader Joe's. If you haven't tried that, please go ahead and run over to your Trader Joe's and go ahead and pick that up. I got the Keurig version of it, so I could just pop it in and get that instant coffee right to my cup. So, leave a comment below. Please let me know what you are all drinking. I'd like to know and possibly try a drink or two that sounds interesting down below. So we are looking at the triple Qs on the weekly candles. Whenever we're looking at the stock market, we always want to look at the bigger time frame, because the bigger time frame gives you key levels of support and resistance. And if I switch this over to here, you can see different levels that I have mapped out for my personal trading. And this is something that I want to help you folks do the same as well. So obviously, we want to look at a clean chart, a clean slate, to look at the weekly candles. Now, we have seen the triple Q move up continuously week after week without any pullback to the mean. And we can attribute this to the anticipation ahead of earnings reports. As we know, there are going to be major companies that are reporting this week. We have the two biggest names, which would be Tesla and Netflix. And that is reporting after the close on Wednesday. Now, we can attribute this week's move to the upcoming report for Tesla and Netflix. And we just got to be prepared for the outcome of whichever direction the market decides to go. And so, looking back at the triple Qs, right, we want to see where the different levels are, where we could find support and resistance, and map out our trade in this sense, right? So, if we look at the lines that I've drawn on, right, we have a major resistance level at 390 on the triple Qs, a double top back here that I'm closely watching that took place in August of 2021 and then September of 2021. This was the 382 level, and this 382 level is coincided to the prior week's upper bound range, right? Upper bound high of last week's trading range. So the market stalled at this point and then pulled back. And then this week we are finally above it, but any breakout, any successful breakout, usually always comes with a retest. And so, are we currently getting this retest to take place at this moment in time? Well, the best way to do that is to go to a closer and more faster time frame. And so that would be the daily chart to an hourly chart. So let's go ahead and zoom in. Now we are looking at the daily chart of the triple Qs. And I'm focusing today to start off with the triple Qs because we have obviously Netflix and Tesla to be reporting, and those two names are heavily influenced in the triple Qs. So what do we have here? We have a high of 385.97. I'm sorry, 387.13, and then the market closed at 385.47. So what I'm expecting to see, if we move into an hourly time frame, so this is an intraday chart of the triple Qs that took place today. Well, I would like to see the market. Obviously, we broke this 382 level, but I'd like to see if we want to hold these levels up here. I'd like to see some sort of retest, right? So what that would look like is a move in this sense where Wednesday's trading range is we could possibly test the current high of 387.13. We could possibly test this level here, but I'd like to see some sort of pullback into a short time frame mean, which would be this 382.50 level, and to test this level here. And based off of that test, we can determine whether or not if this 382.50 is going to hold or not. At this time, we don't have that print just yet, and this is something that we are going to be watching this coming Wednesday during the trading session, right? So we want to see this level here to be tested, and if it fails, obviously we're going to go level to level. You know, how far will this market fall until we can figure out either a consolidation and then possibly a continuing move higher. But at this time, we don't know what is going to happen. So that is why we have different levels, and we plan ahead of the day to really figure out which direction we will take. So if the market were to pull back, right, we want to again zoom out again. So it's a lot of zooming in, zooming out, zooming in, zooming out, yada yada. So if the market were to pull back, the first level of support, in my opinion, is going to be this point right here, because we saw a lot of price action take place at the 379 level, right? If that were to fail, we'd like to see it close this gap right here, right? To pull back into the mean and to test and hold the 15 moving exponential moving average. Now, why am I so interested in this pullback? Well, there's a couple things that I look at, right? First of all, we have a slowing down in momentum on the MACD. So with this run up that we see in the triple Qs, the way I'm looking at this is that we are slowing down the momentum. This hype of running up is fading, right? Based off of the MACD indicator. Now, again, all indicators are not 100% accurate, right? These just give us probabilistic edges that we could use in our trading. So nothing is 100% certain, right? Which is why the number one rule of trading is to always manage your risk and to understand the position sizing that is appropriate for your account size. So again, back to the MACD indicator, we are seeing a decrease in the momentum. Now, another thing that I like to look at, and something that I rarely look at, but every now and then I like to just pull it up on the charts. What I like to do is to switch over to the Bollinger Band. Now, the Bollinger Band tells us the deviation from the mean, right? So this yellow line here represents the mean of the underlying stock, right? And the market, or the underlying stock in this case would be triple Qs, would always like to revert back to the mean. Now, whenever the market goes beyond the upper band and closes above, that could tell us that things are starting to get stretched and that it's almost due for a pullback. Now, if the market can stay under and in between the upper bound band, then it could trend, right? We could use the MACD indicator as our form of momentum, and as long as if the market stays in this upper band, we can continue to see a trending market. Now, something to note here is that no market will ever go up in a straight line, right? There's always a pullback if it wants to continue higher, because that is how you're gonna entice more buyers into the market. Think of it this way. Whenever a professional trader, right, is always going to want to take profits, right, to keep their risk low, right? Nobody, especially if you're traders, right, nobody is gonna buy and hold for the long term, right? There's always the best thing that you can do is to take profits along the way to cut your risk and then re-enter on a pullback. And so that is what we are looking at here, right? We are currently seeing a break above the upper bound band on the Bollinger Band. Oh my gosh, say that 5 times fast. And what we can expect is a pullback to the mean, which will be this yellow line. And so what I'd like to do is show you all what it looks like in a trending market whenever the market closes above the upper band. So let's pull back here. So the trending market that we've seen back here in 2020 is something that we're going to quickly analyze with this particular indicator. So let's take a look here. So we see a close above the band, right? The market traded higher and eventually led to a pullback to the mean. It does this because prices got overstretched. Now, obviously here it stayed within the band, but then it just lost momentum, right? We saw this crossover on the MACD. Let's move a little to the right. We see a close above the band. However, it wasn't yet due for a pullback because the MACD was still printing strong momentum, right? Until it got to this point here, and then the momentum shifted, and then the market pulled back. Let's zoom in a little closer here. We can see a few closes up here above the band, and then the market pulled back to the mean. So you can see this time and time again. You know, it's not an exact science. It's not 100% accurate. However, it can give you an idea of what a stretched market looks like. And in this case, we are seeing an extraordinary stretch market within the past few days. And if we actually look at the fear and greed index, we are currently printing 82 on this indicator, which represents extreme greed. Now, we have to be careful in these moments of time, right? That we do not want to be caught up in this FOMO. So what we need to make sure that we do is, as traders, is to manage your risk and hedge your account. If you've seen my prior video on how I like to hedge, what I explained in there was I like to hedge whenever we see a over expansion in a daily candle where you just see continuous buying print throughout the day, because at that point you're starting to see a sense of euphoric moments in the market where people are buying without the conscience of potential risk, right? As we know, like the whole idea of hedging your account is to basically pay insurance, right? And whenever you're paying insurance, if you don't use it, you know, you lose it, and you don't look at that as a form of waste, right? So let's say if you're paying for insurance for a car, you know, you're paying like 50 bucks a month or even 100 bucks a month, and you don't complain that you lose that each month, right? You're still driving a car, you haven't gotten into an accident, but you're still paying for that. But the moment you get into an accident, you know, you get paid out and then you're recovered. Well, that's the whole point of hedging, right? You're hedging your account to reduce your risk and to reduce the losses whenever the market turns down against the net positive trend that we're currently seeing. So hedging is always a good idea, especially in these times where we're currently seeing a overstretched market according to the Bollinger Band. And so that is something that we want to pay attention to. Looking at the SPY, we are also seeing an overstretched market, right, where the SPY is closing above the upper band. So we may see the exact same thing take place in the SPY. Now, looking at the VIX, what I want to point out here, so let's go ahead and clear this up here. We don't typically use any indicators on the VIX. We just want to look at how volatility is starting to structure, right? So what we have here is the VIX. And something that I thought was really interesting is that we are starting to create a higher low on the VIX. And this is what I had mentioned several times in my prior videos is whenever we start to see higher lows print on the VIX, that could be a sign of a shift in the market where traders and investors and institutional investors especially are starting to price in volatility, right? They're starting to price in a potential rug pull in the market, right? Whenever you start to see this build up, this this higher low build up, especially in the VIX, you better be prepared that something might break in the market, and it's just going to take a headline news to click, and the market will just spike up to 15, and then from there, you'll see a sell-off in the market. If the market holds at these levels with volatility still high, you'll see another spike in the market, maybe up to 18, maybe to possibly break over this level here, all the way up to 18 and then 20. And then 20 is typically the point where you see a turnaround and you see a bottom in this volatility, and then you'll see a continuation higher. But whenever you see this higher low, just be prepared that we can see a possible spike in the VIX, right? So the thing is, like, whenever you look at this, you always want to look at the SPY, and you also want to look at the VIX as well as the triple Qs. And whenever we see the market start to get greedy, you always want to look back at the VIX because it could give you a clue on what is exactly happening, right? Now, if the VIX completely fails and drops down to 13, then it could be a valid reason why the market is going to continue higher. But at this time, there's multiple things that that I would say I would be concerned about, right? We have the Bollinger Band telling us that we are seeing a stretched market. And then we have the VIX that is creating higher lows. And then we also have a slowdown in momentum on the MACD. So all of these things that we have to pay attention to, because the most important thing, if you want to stay alive in this market, you have to, first of all, be aware of what's going on. And second of all, being able to manage your risk accordingly and properly position your sizes in a way that you do not lose too much, but you can position yourself for opportunities whenever they hit. So if you haven't already, please go ahead and like this video. Make sure that you subscribe to the channel, and we will see you on the next one.